What's going on, guys? What's happening? My name is Shocks. This is Shocks Capital, and today we are going to be talking about liquidity. So with this concept today, we are going to be talking about or to be discussing how to exit our trades, how to time our exits in the markets, and how to time our entries too. So with this liquidity concept, we are going to be explaining what is liquidity, what is the best way to enter and the best way to exit using the same principle of liquidity in the forex market. So guys, if you are new here, we talk about forex, financial markets, we talk about institutional trading, talk about order flow, beat the market maker, inner circle traders. So if this appeals to you, you can as well hit the subscribe button, join the growing team. So today we are going to be looking at this concept. So before we go any further, guys, let's explain what's all about liquidity. What is liquidity? How do we spot it, and how do we use it to our advantage in our trading journeys? So let's start with analyzing liquidity. So when we say liquidity, we mean money. So it just means money or orders, to simplify matters. So what we say is, if we are looking at a particular financial market, we are saying people enter the market and they set their stops. This can be sell stops, buy limits, every type of order that you know that is placed in the market. That is liquidity. So what we mean is, if you enter your trade here, you put your stop loss above this structure. So this is your sell, right? Your stop loss goes above. So your market execution is protected by the stop order above here in form of a stop loss. This is some money. Why do I say so? Because if you are wrong and the market comes back to your stop loss, you are essentially buying. Here you are selling, but when it comes back to here, you are buying. So that's a stop order, and that's some form of liquidity. That's money. Why? Because you have lost money at this point. So that's money. So we are going to be looking at this powerful concept with one type of liquidity in the market, because there are many ways to show where liquidity resides in the market. But for the sake of this lesson today, we are going to be looking at double tops and double bottom, equal highs and equal lows. So why do I say so? A lot of people trade the M's and the W's. A lot of people trade the double tops and the double bottoms, and they put their stops above or below the structures. So this is what we mean. It's the surest way to know where liquidity resides in the market without much work. So if you are here, let's say this is a form of a relatively equal highs. So this structure here, if someone is trading beat the market maker, would have seen this M formation and entered after a close below the 13 EMA. You know what you beat MM guys do. So this is your entry, right? Then your entry, your stop loss will go above here. So this stop loss is liquidity. Imagine how many people have their stops above this equal highs. There are a lot of them, because there are people who trade M's, there are people who trade double bottoms and double tops, there are people who trade divergence. So every stop is here. That's why you see the market reacting to this order block right here and going above the equal highs. Why? They are taking liquidity here. So how you are going to be using this is, you are going to be looking for these formations as your targets. So if you enter this order block, this will be what your target here. So this is GPP JPY. You are entering at this order block right here. That's your entry, that's your buy, and your stop loss, and your take profit is going above here. Why? Because you know there are stop orders here. So liquidity acts as a magnet to price. So liquidity will pull price to where it is. So if there is money above here, if there is money here, the market will pull itself to the money. So the price of the forex or financial markets will go where the money is. So the money will be residing above these highs. So if you enter here down below here, you are targeting these highs. Why? Because there is money up there. So the market will go where there is money. These equal highs, these equal lows will act as price magnets. So you want to be drawn to where the money is, and you are in a trade where you are targeting that. So these are relatively equal highs. You enter at this order block. So you know the concept of order blocks. If you don't know, just browse the videos on this channel. You will understand what an order block is. We're saying we enter at this order block, this yellow box, that's your entry there. If you enter here, you're targeting this relatively equal highs. Why? Because they are magnets to price. And do you see this? As soon as it raises that equal high, you are entering, your take profit has been hit here, and it turns away from that. And as it turns, you will realize that we have these lows here. So this is a form of price just consolidating, hitting a zone like this. So with our studies from retail trading, you will know that this is a strong resistance area, and with this we will be looking forward to buy here, and those who would have bought here and not took profit here would have put their stop losses below there. So there is money below here. Why? Because these are engineered lows. They are manipulated laws. Why? Because it's the Asian law not broken. And as this gets into play, you see how this zone was broken, taken out aggressively. So you want to be looking out for this. So liquidity equal highs, equal lows. So those are going to be rated as price starts to move forward. So as I have explained, how you target your take profits and everything. So let's explain how you use this concept to enter trade, to actually enter trade. So this concept of equal highs and equal lows can be used as what? As a way of identifying the stop hands. So from this one, you see that we have an order block right here. That's your order block, and these equal highs, you enter here, you target the equal highs. As simple as that. And as a way of stop hunting, these are used like this. So you see there is liquidity here. If the market wants to go up, it will start to have to take sell side liquidity, which is these ones in form of what? Equal lows. So this is sell side liquidity taken, and the market turns away, goes up. So when you want to enter your trade, you want to identify what is the market done before it retests, or before it gets to an order block. So before the market gets to an order block, we have to understand what it took to get there. So let's say this is an order block here. So this is an order block. Let's say this yellow box. So we before price gets to this order block, it took some liquidity here. So this is a very powerful confluence which you can use together with your order blocks, identifying what the market has done before it got to your order block. So there was money here. The market took that money, get to your order block, reacted down. So this was a form of stop hunting, stop raids, getting the money first, then going in the intended direction. So this is how the market makers move the markets. They take money first, then do whatever they were about to do, or they were going to do anyway. So they get you excited. The market is going up like this, takes all the buy side liquidity. From that, they retest an order block like that. So this is a powerful concept. This is liquidity resting here. This is money. They take money with one candle. This candle here turns away from you, and you'll be left with nothing there. So that's it, guys. This is how you spot liquidity. So you enter there. That's your entry using this order block right here. That's your entry. That's your sell there. You target these equal highs. As soon as it raises that, it's gone, baby. It's gone. So this is what we will do when we use the liquidity concept. So just look out for those equal highs and those equal lows, those M's and W's. Look for that and use it like I was telling you here. So guys, thank you for watching. It's been a pleasure. Don't forget to trade what you see. This is what you see. Thank you.